All right, today we're gonna deep dive into some data and statistics. So for you number nerds, this is gonna be right up your alley. But if you're new to real estate and you're like, well, I wanna buy, but I don't even know where to start, this is gonna really help you give perspective on the real estate market as a whole, because just like the stock market, it goes up and down every single month. And so I'm gonna be able to show you what happened in 2025 and then what we're projecting to happen in 2026, so you can be a more educated consumer as you choose to buy on Oʻahu. So for reference, if this is your first time watching one of my videos, my name is Marina Tolentino, and I've been a realtor for the last 5 years. We own 2 properties now here on Oʻahu using our VA loan. And so I really just love help connecting the boxes and the bridges of I want to buy and I think I can versus I already do and I own a property and now what do I do about it? So between the two, there's a big gap. And so I just want to give you all that information so you can be more educated when it comes to the process. So let's dive in. So for reference, this report is coming from Keeping Current Matters, which is a really, really awesome company that realtors have used to help us condense and kind of break down what the mainland news, like all the different news channels like US News and CNN, plus we have Realtor.com and Zillow.com and Redfin, they all have their reports coming out and they're kind of compiling them into one so we get a broader sense versus the whole thing. And it just helps us kind of break down market data and then again, go down into a local level. And so let's dive into the January 2026 report and what's coming in to the year. So if we look at this slide for mortgage rates trending lower in 2025, this is literally what happened over the last year in rates. And so we see it is a steep decline, but it did go up and down a little bit. Like there in March and April came down, but it shot back up in June, okay? So even though it's trending down, it doesn't mean that there might be some months that it comes back again. And so keep in mind, the thing I like to say is like, don't time of when to buy a house based on rates. Because again, if you've watched our past videos, your interest rate on a mortgage is kind of like an elevator shaft where we can actually negotiate and maneuver that rate based on your credit score, based on your debt to income ratio, and based on any seller credits we might be able to negotiate on the buy side, okay? And then as a seller, don't gauge timing the market based on what rates are doing. Yes, we know that lower rates means more demand typically because it's more affordability, but that doesn't mean that you can't strike an opportunity when rates are high and still really work out a great plan for listing your home during that time, okay? So what does this mean for here? Look, it's still going down. And as we see December 2025, we're actually, if we were to zoom out, it's the lowest we've been in the last 3 years. So let that sink in. Since 2023, we are now in the lowest mortgage interest rates since then. And so what do you think is going to happen to the market? More buyers are going to start to return. The more they start to see that mainland splashed across the headlines, that mortgage rates have hit an all-time low in the last 3 years. Guess what? Now people are getting off the bench. But if you are waiting to time the market, you might be missing an opportunity because now you have more competition, okay? So let's go to the next slide. What happened to our growth in our properties? This is a map of the United States, and you can see we have some blue states and some orange states. So the orange states actually dropped in value, but you can see there specific for Hawaii, we actually went up about 3.5% in Q3 of 2025. And so despite the national average being 2.3, Hawaii is once again outperforming the national market. And we tend to do that no matter what, just because we live on a little rock and we have a lot of people and we have more people wanting the homes than we have available in inventory. And so again, this is, when I do my briefing on Schofield, I always talk about we are an appreciation state. We are not a cash flow state. So when you choose to invest in a property on Oʻahu, you are banking that this property is going to go up in value significantly over the 3 to 5 years you're going to own it versus getting a really low mortgage, being able to rent it out in cash flow. Your mortgage might be higher than a rental market, so you're kind of at a deficit, but when it comes time to sell, you're sitting really pretty with some net profit. So here's what inventory has been rebuilding gradually, and this is a big chart, and I know it's a lot to look at, a lot of lines. If you look on the left side, that's 2017, and we're going all the way to 2025. So really what we're looking at, it's that white line is gonna be November, and so we're seeing inventory is coming up, right? That's 2025. This is what's happening. In 2017, 2018, 2019, those gray lines, it was much, much higher. So we're seeing this up, we're getting closer to those 2017, 2019 numbers. So just recognizing more inventory, more options, more affordability, okay? Then let's go into 2026. What's gonna look like for the whole year, right? What can you expect as a buyer or a seller this year? So Realtor.com is saying in 2026, we expect a housing market that's steadier, but not yet off to the races. And I want to emphasize on this because I feel like I'm already seeing on social media, people are they're clickbaiting that 2026 is going to be like this fire year. It's going to be awesome. To me, that's like advertising it's going to be a dangling carrot like 2021 and 2022. We're not going to see 3%, 4% interest rates, but we are going to be in the fives most likely, which even just a 1% drop saves people hundreds of dollars a month every single month on your mortgage. And so when we talk about the entrance factor and affordability, that is a big difference. And steady, to me, steady is healthy. Steady is more balanced. That means we have a more equal number of listings to buyers. We're actually stable and we're not doing this like jerky, crazy stock line, right? It's more steady. So Jake Krimmel from Realtor.com is a senior economist, and he says, we anticipate affordability will improve modestly on average. This results from our expectations of slightly lower interest rates, an only modest increase in home prices, and a more balanced market than in recent years. So affordability is rates plus wages plus prices. So that's how we get our factor. As we go into next year, the mortgage rate will be a little bit better. It's not going to be a big decline, but it will be a modest decline that will improve affordability. And that's from the chief economist from NAR. Here's what we're looking at. Again, if the actual is the orange line, we're looking at potentially, Fannie Mae is saying we're going down to 5.99%. And this was in Q4. Oh, wait, sorry. We're looking at Q1 through Q4 of 2026 in the dotted lines. So it's not crazy. It's really like subtle. But if you compare that to 2025, we were up to 6.8. Now we're a full 0.5% lower. So again, saving people hundreds of dollars a month on average. Realtor.com is saying, while this puts the average 30-year fixed mortgage rate on par with the last few months of 2025, it will mark a drop from 6.6 on average throughout 2025 as a whole. So again, just reinstating, it's a drop. It's enough that it makes a difference. All right, so here's an estimate of what we think home prices are going to do in 2026. So you can see on the bottom, we have all these different sources from Fannie Mae, Realtor.com, Wells Fargo, NAR, Zillow, Redfin, MLS, Bank of America. All these things in the green is how much they're anticipating it to go up. But really, we're focusing on the blue. On average, nationwide, we're expecting home prices to go up 1.6%. But reminder, we're Oʻahu and we don't follow national trends. We usually outbeat them. So I would say we would double that. We could even go 3 to 5% increase in value just because demand is going to be back a little bit better. Okay, so Realtor.com is going to talk about wages here. So they say rising incomes, which should outpace inflation, give buyers more purchasing power. It helps to shrink the share of the paycheck that has to be put towards a mortgage. The monthly payment to buy the typical home is expected to slip down to 29% of your median income. Its first year below the 30% affordability threshold since 2022. So to break that down, what does that mean? It means 2022, 2023, 2024, 2025. And right now, our affordability has been over 30% of your paycheck has to go to your house for you to afford it. And we know affordable means we should be able to spend only 20% of our monthly check towards a house. So we've got about a 10% gap we're still trying to minimize. But even slipping into 29, that's progress, guys. We'd have to celebrate the baby steps. And so anything that the government can do and our banks can do to help lower that affordability that's a win, and it's worth being celebrated, okay? So here's a chart that shows wages are gonna grow faster than home prices. So yay, we're making progress. Again, emphasizing baby steps here. But if you look, the blue is gonna be our wage growth and the green is our home price. So obviously pandemic, home prices shot up through the roof, right? We saw, on this chart, they say a max of 16%. On Oʻahu, some prices we saw 20% appreciation. And we can show that through the MLS historical data. So our home prices just significantly jumped up during the pandemic years. And then 2022, what happens? Oh, we're way below on price growth. So like a drastic drop. We went from 16% down to 2%. So a major difference. But now our wages are starting to come up come 2025, 2026. So wages up, prices like this, guess what? More affordability, right? More of your paycheck can go towards your home. So a challenging period of buyers for sellers and buyers and renters. 2026 is going to offer a welcome, if modest, step towards a healthier housing markets. Our incomes are finally going to climb faster than inflation for mortgage rates at a steady lower level, creating space for affordability to improve. And again, that's from the chief economist at Realtor.com. All right, so let's talk about inventory. Well, that's great if wages come out and prices are the same, but what about how much homes we have for sale? Because that's the whole tug and pull of supply and demand, right? So based on this, inventory is expected to rise an average of 9.9%. So that's about 10% increase in homes available, which again, the more options we have, the less competition we have, and you can actually negotiate a really good deal typically if there's more homes available. It just makes sense, right? If I'm looking at a neighborhood that I want to move to and there's 30 homes available, well, guess what? There's a lot of competition for that seller. Versus if there's only 2 homes available in that neighborhood, beggars can't be choosy. I just got to pick, and I have more than one person going for those 2 homes, right? That kind of makes sense. New construction is going to slow down, but just slightly. So in 2025, they did about 1.3 million in homes, and this year in 2026, they're looking at about 1.2 mil. So about 100,000 less housing units expected to be built. But this just shows right here, the market is again undersupplied. We have more demand for houses than we have available. And so what does that mean? Appreciation, because we just have more demand than supply. So costs slightly up, but nothing crazy. Again, nothing out of the normal. Okay, so Lisa is the chief economist for Bright MLS, and she says, while lower mortgage interest rates and more inventory will bring some buyers back, this is going to be a reset year, not a rebound year, okay? Market performance will hinge on local economic conditions, making 2026 one of the most geographically divided markets we've seen in years. This one's interesting to me because, again, I think I'm already seeing a lot of those clickbaity things of like, this is the time, get off the bench. And like, yes, there's a lot of opportunity, but it's not a rebound takeoff, it's a reset. It's like, let's normalize, let's get healthy, let's get steady instead of this yin and yang that we've seen over the last 5 years. All right, so to end this off, I just want to emphasize who you choose to work with matters. And so there's just end slide here that I think says it all. It says most agents know what's happening. Okay, so for reference, locally, we have 11,000 agents on the island of Oahu. Most of them have an idea of what's happening. At least they should if they have a license, right? Now, secondly, good agents understand what's happening, right? They can actually like help someone explain it a little bit, maybe not, but they kind of like get it. So there's like knowing, understanding, but the best agents can explain it. And hopefully that's what I'm doing to you today, is helping you chew on this, consume it, so you can actually make an educated decision about what to happen. But I have a document called 20 Questions to Ask Your Realtor that I feel like every single person should interview their agent. Just because someone referred it doesn't mean they're the right fit for you. Just because they have 100 reviews doesn't mean they're the best person for you, because every family is unique. Personalities differ, needs differ, time availabilities differ, right? Response times differs. And so I just want to put that out there, that just because you see something flashy or it has like veteran in their business name or whatever, do your due diligence. This is going to be the most expensive investment decision you're going to make on buying or selling a home. And so I want to make sure that you can sleep well at night and have confidence with that move. And I hope this video really helped, and I can definitely share these slides with you if you are curious and you want to go through them again. Please send me an email. But more than anything, I think if you own a home and you're planning a move in the next 12 months, let's sit down, let's look at your market value, not as estimate. And as much as we all love Zillow, sometimes their estimates are not accurate because they'll take a wider zip code search versus your neighborhood specifically. So I can look at just your neighbors, what their value is versus yours, and what it would look like to sell. We can run a net sheet and say, hey, your mortgage balance payoff is this, your market value is this, what's the difference you have there, plus closing costs, you're looking to get a check for XYZ. And then some different strategies on what to do once you sell. And then on the buy side, again, affordability. What do you actually want to pay every month? That's how we're going to reverse engineer your roadmap to decide if you should buy or not. Is renting a better plan for you? Should you buy now? If you do want to buy, how do you get there? All of those questions can be answered on a simple 15-minute call with me, which the link is in the bio below. So I look forward to seeing you guys next week with another video. Bye.